Hello YouTubers, welcome to the Independent Investor for February the 7th. I thought just make a quick video now. The markets have settled out a little bit. We've had about a 4 to 6% correction on the NASDAQ, S&P 500, and the Dow Jones having one of its worst days in quite a long time, with over a 1,000-point drop. And I just thought I'd review a few charts, seeing if this is maybe the beginning of a bear market, or where we might see a 20% correction or more, or just a bit of a sell-off and the market turns around and maybe goes to new highs. As I've mentioned, I feel this market from a fundamental value is quite extremely overvalued. The one thing that was really propelling it was low interest rates. And really, there was no other option. You couldn't really buy bonds that had any kind of coupon. But that has changed. We've, over the last year, the Federal Reserve banks around the world have been taking money off their balance sheet, or reducing the amount of bonds they're buying, more so in the United States. And in the United States, they have actually increased the interest rate. And we can see that on the 13-year Treasury has really gone from about 0.3% to 1.54%, which percentage-wise is quite a large amount. And then we can see on the 10-year we've gone from 1.8% right up to 2.9%, and the 30-year now has actually gone over 3%. Some of these are actually reversing trends that have existed for over 30 years, since rates kind of peaked in the early 1980s. And this could, well, with interest rates coming up, it can really impact the equity markets for several reasons. But one reason, a lot of pension funds and mutual funds will start selling equities and buying bonds because they're a safer investment, and that will cause money to move from the equity market to the bond market, which I think was catalyzed this correction. Plus, there was a lot of ETFs that had been created selling the volatility through options on the VIX, which is just a measure of the overall market volatility. And with market volatility on the VIX staying low for very long, it was kind of quite a money maker, with some ETFs reporting, I think, 60–70% gains. But like anything, when too much money enters it, that there's typically a correction. And we did see this, where you can see the VIX was sitting around 12 to 18, and then we had this huge spike up to 34. And that sometimes those kind of corrections do feed on themselves. So that was another factor. Another thing is the yellow wave. We've seen 5 good waves now. I've had in the history of a hard time really applying this, but it has worked for this bull market, where we've had one wave up, and then a second wave down, a third wave up, fourth wave down, and then a fifth wave up. The fifth wave is usually the last wave. It's where more investors get drawn into the market, and a lot of times where a lot of the professional money starts to get out of the market. And we did see a short drop here, but it's too early to tell where this is the actual end of this bull market. On the day the market was correcting, I did decide to actually sell a lot of positions and just go to cash and wait and see how this plays out. I am doing the option side, doing a lot of bear call spreads just for income above stocks that I still feel are very, very overpriced. And one other measure is the S&P 500 rate of change. And this has been very accurate over the years. When the rate of change goes above 20% and then drops below 20%, either positive or negative. Right now, we have dropped down to 14%, and I would like to really, for confirmation, see that drop below zero. But as an example, back in 2008, we had that run above 20 down, and we went all the way to minus 40, and then when it retraced that to about minus 20, that would have given a very good buy signal. And so we have seen the drop, but there is quite a bit of chatter in this index, and even towards the beginning, I kind of ignore this, but I pay more attention in the later stages of a bull market. And we'll continue to monitor that. And we're also seeing the skew for options is still relatively high, meaning people are, the implied volatility is people willing to pay more for options that are way out of the money, which means they're expecting a bigger market drop than normal. The skew is usually around 100%. It's at 129 right now. So that's just a few charts. It's still early days. The market is very expensive because the Federal Reserve, as I've spoken about in the past, has printed so much money. This money does make it into financial assets, and with them starting to reverse those policies now, we could see a sizable market correction. So that's just a few charts and a bit of an update, in my opinion, what's taking place right now. And I'll continue to monitor these charts along with quite a few others and give an update in a week or so. Thank you for watching. Bye.